interest-only mortgages in the UK. Let's take a look at eligibility, repayment plans, and the risks involved. Now, interest-only mortgages are often discussed in terms of lower monthly payments, and that's true. However, the capital balance isn't automatically reducing, whereas it would be with a capital and repayment mortgage. So, understanding how repayment works is essential before considering this structure. Otherwise, you're going to end up 30 years down the line and still have a whopping great mortgage loan. What is an interest-only mortgage? With an interest-only mortgage, the monthly payments cover the interest only, hence the name. You're not chipping away at the capital repayment, and that capital is going to remain outstanding at the end of the mortgage. Therefore, a repayment strategy is required. The lender's going to want to know, how do you intend on repaying that capital at the end of your loan? At the end of the term, that loan's got to be repaid in full. So at the application point, they're going to be asking you what the plans are to do so. Let's look at some repayment strategies then. So lenders are going to require evidence of how that loan's going to be cleared. This could be sale of the property and downsizing into something if there's enough equity that allows you to do that. It could be the sale of other assets. It could be looking at the value of investment portfolios or pension pots and pension lump sums, looking at how that might be cleared, of course, subject to criteria. Each lender has their own acceptable defined strategies, and they're all going to treat that differently. So making sure you know how you're planning to repay that loan is going to be a really important factor when deciding that lender up front. So let's look at some criteria expectations with interest-only mortgages then. They're typically going to require a higher minimum income for the sole or joint borrowers. Typically they're going to want more equity in that property, so probably a lower loan to value, and they're going to want a strong credit profile as well. They're generally more restrictive than repayment mortgages, and there are less options for those on the market, so making sure your circumstances stack up is going to be a really important consideration. Let's think about some of the risks involved with taking an interest-only loan. So property values can fluctuate, so investment returns are not guaranteed. Refinancing later may not be available. Without viable repayment strategies, property may need to be sold, so you need to be really aware of that when considering taking out an interest-only mortgage. So what are some of the key takeaways then with interest-only mortgage lending? Well, the capital is not automatically going to reduce. Make sure you have a plan for how you're going to repay that loan, and that's called your repayment strategy. The lender will want to know what that is up front, and different lenders will use different allowable strategies. Criteria is typically going to be stricter. They're going to want to know more about you as a borrower. Advice is always recommended when taking out this type of loan. If that's been useful and you want to learn a bit more about interest-only eligibility, then click the link below to download our handy guide.